The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Will he or won't he? Jay Powell's future hanging in the balance. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. That question really came to the fore today.
Yeah, you saw big spikes in the market.
All right, let's show you what happened here. Let's get a check on the financial markets. The S&P 500 currently up 0.3%. Don't let the modest moves fool you. There's plenty of price swings following reports that Trump told lawmakers he may fire Powell, and then the president denying that would happen. What we also saw was a twist steepening in U.S. Treasuries. The two-year yield falling sharply, currently down almost 6 basis points, while the 30-year bond yield did rise at one point. The Bloomberg Dollar Index, measuring the U.S. dollar, giving up earlier gains, now down 0.25%, and Bitcoin resuming its rally as House Republicans try to get their crypto week back on track.
Yeah, but let's go back to the parlor game right now going on in Washington and Wall Street. We really did see early in the session stocks really trying to attempt another push to a record high, but the durability of that rally got a big test just before lunchtime today. That's when a flurry of news reports started to cross the wire that President Trump had not only drafted a letter to fire Jay Powell, but had actually consulted with Republican lawmakers on whether they would support the Fed chair's removal. Now, the knee-jerk reaction in markets, as Scarlett was talking about, did reverse just as quickly as it began. This was after Trump, in that White House comments, threw cold water on some of those news reports, saying he's standing behind Powell. But just add this to the drama, the big heap of drama out of Washington right now that markets are being whipsawed by. In fact, the political pressure, coordinated political pressure, we should point out, is clearly designed to force a more dovish Fed. But that political pressure, it actually kind of overshadows the reality that the economic data might be all the pressure that's needed to support a rate cut. Exhibit A, another benign inflation report this morning, this time on wholesale prices, pushing Treasury yields lower for the first time in a week on welcome relief that inflation might indeed be constrained despite tariff concern. That means that the pain trade now, whether it's tied to inflation expectations or whether it's tied to expectation about Powell's future, that pain trade is likely lower yields. Scarlett?
Yeah, well, who knows how it all plays out. Speaking of Powell's future, we showed you how the bond, stock, and currency markets reacted to headlines that Trump may soon fire Powell. Here's how it looks in the prediction markets. Odds that Jay Powell will cease to be Fed chair by the end of this year have been steadily rising over the past month as Trump and his allies steadily make the case that he is too slow on cutting interest rates. Now, at one point today, Polymarket odds, which is the white line, reached about 38%. The same bet on Kalshi, which is the blue line, reached about 40%. Both those markets have since pulled back to about a 1 in 4 chance. Romaine?
All right, let's kick things off right now with Lael Brainard, former vice chair at the Federal Reserve and former director of the National Economic Council, now a distinguished fellow over at Georgetown. Lael, there's been a lot of discussion right now, not so much just about the idea that the president wants Jay Powell gone, but more so about the reasons as to why. I know on the surface, he talks a lot about this idea that interest rates should be lower, in his view, 1, 2, maybe even 3 percentage points lower than where they are right now. But my question for you is why? Exactly why?
So, first of all, it's nice to see you. It was surprising to me when the president wrote a handwritten note to Jerome Powell telling him that lowering interest rates would save money for the Treasury. And he said it even more explicitly in an event for the Republican mega law, where he said that for every percentage point cut in rates that the Fed does, that translates to $300 billion a year in saved interest payments on the debt. And what is very surprising about that is that the Federal Reserve has a clear mandate from Congress to focus on fighting inflation while keeping the labor market strong. It is not supposed to be changing interest rates to affect the amount of interest payments on the national debt. And of course, it would be self-defeating if investors thought that the Fed was going to subordinate its inflation mandate to Treasury debt management.
This gets to this idea that's come up, this idea of fiscal dominance, and that one way or another, given our deficits and given at least the stated intent out of the Treasury Department going forward, we're going to get a lot of issuance coming out of the Treasury space, both needed and maybe in some cases not needed. And that is going to potentially maybe blunt the ability of the Fed to fight inflation. So why would going with the flow, meaning cutting rates in service of some of that Treasury issuance and the deficits, actually be beneficial?
Well, I think that what is important is for bond investors who are, at the end of the day, going to decide how much they need to be compensated to hold treasuries. What matters to them is that the dollar holds its value and that those treasury securities hold their value because inflation is kept low. So for the markets, it's extremely important that we have a Federal Reserve that has the independence to keep inflation low and predictable, to make sure that those treasury securities hold their value over time. And that is, I think, the problem with fiscal dominance, this idea that if the new Federal Reserve chair, when the president does get a chance to appoint a Federal Reserve chair, if that person is prioritizing lowering interest rates on the national debt, that will lead to a loss of credibility on keeping inflation low, and paradoxically could lead investors to demand more to hold those treasuries.
Lael, I mentioned earlier how we've seen the 2-year yield fall sharply and the 30-year yield rise. This twist steepening has pushed the 5/30s curve to the widest level since 2021. Do you think this is an appropriate reaction?
So it's certainly the case that we heard all those rumors out there starting the day. Who knows how much credence to put on those, because, of course, the president then walked them back. But they certainly are quite a distraction. And it would be if you're trying to figure out what is going on in the markets, it would be logical for people to think, well, maybe you get a Fed chair in sooner that's going to lower rates by more in the short run, but actually the payback will be that loss of inflation control, that loss of credibility that actually drives longer run Treasury yields higher.
Okay, so that's the market reaction part of it. I'm curious to get your take on how this affects people and their behavior. We know Jay Powell has the support of his global peers. Christine Lagarde gave him a big shout out at the ECB forum in Sintra, praising his courage. If Powell were to be pushed out before his term ends, talk about the implications for other central banks and whether that would influence how monetary policy making is conducted in other countries.
Well, look, if there were a serious effort to replace the Federal Reserve chair before the end of the term, first of all, that is, we think, likely to be illegal. The Supreme Court weighed in on the side of the Federal Reserve being quite different from other independent agencies. And so it would really call into question the entire institutional structure that undergirds the Treasury markets as being the safest asset in the world. It would really undermine the institutional structure that has so clearly anchored inflation expectations in the United States and kept the dollar as the kind of dominant global currency. So it would have, I think, quite important implications globally in terms of investors' willingness to continue giving the U.S. that exorbitant privilege, which means that the U.S. federal government can actually borrow at lower rates than other peers because of that special role of the dollar.
I am curious, Lael, if you could just kind of give our viewers a little insight as to what goes on behind the scenes. You were at the Fed for a decade, and obviously the last year or so as vice chair. There's been a lot of speculation that if Powell were to be removed early as Fed chair, obviously he would still potentially legally have the option to stay on in his role on the board. There's been a lot of discussion about whether you would actually see a break in the Fed chair leading the FOMC, and not only leading it formally, but also just leading it in spirit. The idea that he or she has kind of set the tone for these meetings and for the decisions, at least as they're publicly released, and whether whoever the replacement is for Powell could maybe bring a level of contentiousness where we can see that streak, that history streak, break down.
Well, I do think that the Federal Reserve is a very strong institution that has a strong culture. Remember, monetary policy is not set by an individual. It is set by a committee. All the members of the board vote for monetary policy decisions every time. And I think you were alluding to this. The chair's position is the term ends in May of 2026 next year, but the actual board position of the current chair does not end until January of 2028. So there is a scenario in which a chair can stay on and fulfill their term as governor. That has happened before with Mariner Eccles, and that could happen in this case. And I think it would be very important for whoever comes in as Federal Reserve Chair, hopefully at the end of the current chair's term, to build trust with the other members of the board, as well as with the Federal Open Markets Committee more generally. So they will be quite constrained by the voting and the structure.
Of the names that have been floated out there publicly, Kevin Hassett, Kevin Warsh, Christopher Waller, Scott Bessent, who do you think would best fill that role?
So look, all of the names are people that are very qualified. And so the real question is how much the mechanism of putting pressure on the current Federal Reserve Chair undermines the perception that any appointee under these circumstances would be truly independent of the White House and able to conduct monetary policy under the normal institutional conventions that have prevailed for many decades now. Yeah. So again, I think the candidates themselves are qualified and credible, but unfortunately the process that's going on right now and some of the statements that they are making really might raise concern, again, in the markets, which is really very important, about how independent they will be able to be as chair.
All right, Lael, really appreciate you taking time for us. Former Fed Vice Chair Lael Brainard there as we keep a close eye on markets. Scott Chronert going to be joining us after the break. We should point out that knee-jerk negative reaction that we did see in the markets has now been completely erased. In fact, stocks right now at session highs. This is Bloomberg.
The post-Liberation Day rally has left U.S. stocks trading at a big premium to global markets once again. According to Bloomberg Intelligence, the difference is this time around, U.S. profit advantages are eroding. Operating margins for U.S. companies outside tech are converging with international peers. Let's talk more about the fundamentals of U.S. companies this earnings season with Scott Chronert, U.S. equity strategist and global head of ETF research at Citi. Scott, always a pleasure.
Great to be here. Thanks, guys.
So will those ex-tech margins be enough to support another beat and raise kind of quarter?
I think it depends on time frames. I think the setup here is for a very good Q2 reporting season in terms of a traditional beat. I think we're going to get that, and we've seen evidence of it so far. The question is the raise, right? And our view has been that there are enough ongoing policy issues out there, whether it pertains to some of the tax components of the most recent bill, whether it pertains to where tariffs are going, that we think most C-suites will express, decent conservatism around the back half. That's not a bad thing. It's not a bad thing because what it does is set up again, as we have going into Q2, we're a decent positive surprise. But also, I think the focus as we go into the second half of the year, yes, Q2 earnings are important, but the stage is setting here for how we think about the progression into 2026 already.
There's so many investors who say that they just want to look past the rest of 2025 and get to 2026 already. So from where you sit, how does that 2026 outlook shape up?
Well, so we're pretty constructive, right? So we're looking for S&P earnings growth this year in the mid-single digits, but we think that it accelerates next year to low teens, 13, 14%. That's not too far off where consensus is right now. So the setup here is that you put a lot of the issues that we've been confronted with in the first half, whether it's tariffs, other related policy, whether it's DeepSeek, whether some of the geopolitical things, all of that is increasingly moving to the background. We may not be coast as clear yet on tariffs and other policy initiatives, but we've dealt with the maximum uncertain effect, right? Mm-hmm. And we're still looking at a fairly decent, fairly robust fundamental setup for U.S. equities. So I think the angle we're coming at it from is that structurally, large cap equities here in the U.S. are in pretty good shape, right? And we think that you have this AI infrastructure spending tailwind that's ongoing here that should continue to support it. In fact, it's showing signs of broadening out.
Even at current valuations and multiples?
Well, the moves are pretty astounding, pretty real time, right? So that's where you have to look at what's the persistence of this. And so if we're still of the view that we're, let's call it early innings in terms of the AI infrastructure build out, then valuations are a concern, but they're not a reason to jump ship. And so the way we're positioning this as going into the second half is we're looking for a persistent degree of volatility to be at work here. And so the messaging is be prepared to buy pullbacks and don't chase rallies.
I mean, I know the arc of history in markets is usually to the upside, but there has been some concern about complacency. The idea that you have so many people betting that the worst is behind us, betting that there is a lot more life to this rally, and not necessarily protecting themselves or hedging in a great deal of fashion for that potential shock, whether it's from tariffs or something else that comes out of the blue. Does that worry you?
It always worries me, but it's time frames. It comes back to, again, structurally, we think we're in pretty good shape here. Now, if we were to come in and something were to really disrupt the AI infrastructure spending narrative and influence that mega cap part of the market that's been so influential of the index move, okay, we'd have to take that into consideration. But right now, what you're looking at is a market environment where, for the most part, stocks in different areas of the market are reflecting where current expectations are. So you have very extended valuations for this growth part with a very clear, fundamental underpinning to it. But you've got other areas, whether it's the home builders, whether it's areas of retail, even small mid-cap that haven't really participated. So the market's pretty efficiently pricing where the growth is and where there's concern that it's not.
Scott, very quickly, the president signed the One Big Beautiful Bill after the second quarter ended. How much of a boost is that going to be to earnings going forward, or is it a wash given all the tariffs?
Yeah, it's a really good question. So two answers. The first is our math is that the accelerated depreciation, bonus depreciation, RD expensing, and then sort of the tax component of it all can add 5 to 6% to S&P earnings. Okay, so this is a very clear positive. It varies by sectors, okay, but in aggregate, that's a positive. We estimate that it brings about 260 to 270 billion of a positive read-through to earnings. Now, here's the other side. Our tariff math is that tariffs, which are essentially an incremental tax burden on the importer, in many cases the U.S. companies, are probably going to cost companies about 200 billion. Which probably comes a little bit of a gross margin pressure issue as that unfolds. So they kind of balance off, right? And so I think that's what the market's telling you. It's like, okay, we've got some news here, it's good, but let's not read too much into it because it's not really persistent. It's sort of a one-off deal.
All right, Scott, always great stuff. Scott Chronert, U.S. equity strategist, global head of ETF research over at Citi, as we continue to roll on here to the close with a look back to this morning and some of those results out of some of the big banks. Bank of America, Morgan Stanley, Goldman Sachs all had something to say. A breakdown on what they said when we come back after the break. This is Bloomberg. Big moves today in big banks after earnings reports from Goldman Sachs, Morgan Stanley, and Bank of America, moving in different directions and in different magnitudes, despite the fact that we saw records for trading revenue pretty much across the board. David George joins us right now, senior research analyst at Baird. And David, let's just talk about the overarching theme. The main positive that we've seen so far out of these big banks has been the volatility in markets and the boost to trading revenue.
Yeah, that's right. Good afternoon. I think that's right. There was a lot of what I would call good volatility at the beginning of the second quarter, particularly in the April and the first half of May. And then we kind of carried over into the second half of the quarter with a pickup in what we'd say maybe is a more capital markets driven strength, and trading continued with obviously the strength in the equity market and the trading that accompanied that. We also saw, Romaine, a pickup in equity issuance, secondaries, IPOs, as well as a pickup at M&A. So fortunately, the capital markets saw a very nice quarter and one of the best quarters we've seen in a couple of years.
Yeah, there was a lot of commentary about how the first half of the quarter started kind of slow and then things picked up as the quarter went on. Clearly, trading desks were the stars with that monster second quarter. The question is, how sustainable is that? Is that good volatility set to last into the second half?
From my perspective, I think the equity volatility is probably going to slow a little bit as we go through the balance of the summer. But I think the IPO and secondary pipelines at most investment banks are pretty high, and the number of private companies that need to sell are at records as well. So I think activity levels, provided that the markets can hold, should be pretty strong in the second half of the year. So I think it's going to be maybe a little less trading strength and a little bit more pickup in M&A and equity issuance, which is actually higher margin capital markets business than trading.
What's been your main takeaway so far, David, this earnings season on the commentary regarding the health of the consumer and obviously how that dovetails into their lending practices and, to a certain extent, any money they need to set aside for loan reserves?
Yeah, the credit quality data, Romaine, continues to be excellent, really across the board, whether you look at the money center banks or the regional banks that we've seen so far this week. And if you just listen to, I think that Bank of America really provides the most illustrative look at the health of the consumer, and they give some detail around consumer spend. It's over 5%. Loan growth at the banks really saw an improvement as well here in the second quarter. So knock on wood, the consumer continues to be in good shape. We're obviously continuing to watch signs of claims, continuing claims, initial claims, to get a sense as to kind of the trajectory of things with the consumer. But for now, certainly things do seem to be pretty good.
I look at the performance of bank stocks over the past 3 months. The KBW Bank Index has returned about 30% in 3 months, outstripping the S&P 500's 20% gain. We know a lot of tailwinds have been priced in. What hasn't been priced in, David?
I think a lot has been priced in. I think that the best you can hope for, Scarlett, from here is just a continuation of what we've seen, and perhaps the multiples can hold. So I think it's very reasonable to assume a much lower equity return as it relates to financials from here relative to what we saw in April. We upgraded, I think, 8 stocks in that April panic, and we've downgraded 3. And I think the risk reward today is just okay, a little more balanced than it was in April. And I think it makes sense to kind of curb your enthusiasm, as it were, as it relates to the strength in these stocks.
All right, good stuff. David George, Senior Research Analyst at Baird, joining us on a wrap-up of the big banks earnings season. Curb your enthusiasm was the theme. But, of course, a lot of what's been driving the bank stocks as well is that return of cash to shareholders.
Yeah, which they certainly know how to sort of pull that lever when they really need to. And that, of course, keeps investors happy. And it's one of the reasons why, at least as a group, you've seen financials either at or near record highs.
Absolutely. All right, coming up, we're going to speak to Hamid Moghadam. He is the CEO of Prologis, which is the world's largest industrial real estate companies, on the heels of the company's earnings. Clearly a lot to talk about, especially with tariffs and all the headwinds that has created.
This is The Close on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu. It's still earnings season, although we kind of forgot about that this morning, given all the drama surrounding Trump and Powell.
Yeah, that really kind of sucked a lot of attention out of the room. But earnings are pretty much the bread and butter of where the market is going to go next. We heard from some of the big banks, but we're starting to hear from companies outside the financial sector that might give us an even better read on the health of the economy.
Especially when it comes to the industrial economy, because that's part of what has a lot of investors excited about what's moving forward. And one good way of looking into that is Prologis, which is the industrial real estate investment trust. The shares are higher right now on the results, up 1.5% after the company reported better than expected second quarter results. So joining us now is Hamid Moghadam. He is CEO of Prologis, the world's biggest industrial REIT. They specialize in logistics and distribution facilities. Hamid, thank you for joining us today.
Great to be with you.
So last earnings season, it seemed like the takeaway was that the escalating global trade war was fairly good for Prologis, and that demand for storage space increased as companies stockpiled their inventory. How are you positioned now, 3 months later, with some tariffs already in place and the president constantly threatening more tariffs?
We are a barometer of the consumption economy, and our customers basically do the equivalent of 3% of global GDP in terms of business every day through their buildings. So it's a very broad-based business, and the condition of each sector is very different. For example, consumer products companies are expanding and taking more space. Housing-related companies are doing less well because the housing market has been slow. So really, we are a reflection of the broad economy, and you got to go sector by sector. But I would say, just backing up and giving you a general answer, we ended the year very optimistic, and the first quarter was fantastic. Our earnings call for the first quarter was in the middle of February, in the middle of April, right after this April 2nd events. And we were pretty pessimistic at that point because the customers had stopped doing anything in those 2 or 3 weeks. But gradually, the freeze thawed, and May was better, and June was quite a bit better. So we're feeling good about our business, and we went back to our original view of the economy at the beginning of the year, and actually raised and tightened our guidance. So right now I'm feeling really good about it, but boy, it can change any minute.
Yeah, it certainly can. You get more than 90% of your revenue from the U.S., followed by Europe and then Asia, but those are low single-digit numbers. How has warehouse demand evolved overseas as this trade war progresses?
Yeah, our business is actually much more balanced between overseas and U.S. It's about 55-45, but we own more of our partnerships in the U.S. than we do in Europe. That's why your earnings numbers are a little bit different. But so we have a good perspective on both Europe and Asia and also Latin America. I would say Latin America is on fire, particularly Brazil. Mexico is doing really well. Japan is kind of, bumping along like it always does, 1%, 0 to 1% growth economy. China is definitely improving. We're past the bottom in China, which is surprising, I think, to some people. And Europe is, by and large, a slower version of the U.S. In terms of our business. The U.K. is doing probably a little worse than the rest of Europe, but the continent is doing fine.
So, I mean, I am curious, though. I mean, when we talk about just the whole supply chain structure, and I mean, obviously, so much of what you do or what your business does affects us all. Basically everything that we're wearing today probably at some point or another maybe crossed through one of your warehouses. When you look at the disruptions, though, from the trade war and from other supply chain issues unrelated to the trade war, do you see this as a truly structural shift in how things are bought, sold, stored, and distributed to the customer, or is this temporary?
I think it's a combination, but I think it's more temporary than structural. The way to think about our business is not to worry about what happens in the middle, but at the end of the line, it's all about consumption. Everything, like you said, in your office, in your home, what you're wearing comes through our building. And if you're feeling good and you're consuming, we got to get you those goods somehow, somewhere. And unless you beam it up, it's got to go through a warehouse, which is located at a port or a major transportation hub. So it may shift around where the product originates from. It may be less from China, more from elsewhere in Asia. But at the end of the day, it's got to hit the LA port. Otherwise, we can't get it to you in different parts of the country.
Right, and that's being disrupted right now. Just real quickly, I do want to get your thoughts on how immigration policy is affecting your business, particularly with regards to expansion, finding new properties, building those properties, and finding the labor to do it.
So I believe construction costs are going to go up radically. They have in the last couple of years, partly because of the labor shortage, but also because of the vagaries of COVID. We thought they were going to stabilize this year, but I think all this immigration stuff is putting more pressure on construction costs going up. And also, there are still some big chip plants being built that put a lot of pressure on materials and labor going into the construction industry. So that's making it a little bit difficult. By the way, it makes our existing buildings, which we have about 200 billion of, a lot more valuable because it's going to cost more to replace those buildings. It is a real issue for our customers because they need people to work in their warehouses. And often those are the same people that are having immigration issues. So they're being forced into more automation, which is not necessarily economic at this point in time, but they kind of have to do that to be able to make up for the shortage of labor. So it's got all kinds of effects. And I honestly don't know where the employees are going to come from that are going to do all this manufacturing that we're talking about.
All right. We have to leave it there. Hamid, really appreciate you taking time for us. Hamid Moghadam is the CEO of the warehouse company Prologis. Stick with us here on The Close. When we come back, we're going to revisit what's going on with Crypto Week. It hit its speed bump yesterday. Apparently today, based on news reports, it might be back on track. A conversation with William Quigley, the co-founder of Tether. This is Bloomberg. All right, we've been talking about Crypto Week. Well, that did hit a snag yesterday, and it's still snagged today. A key procedural vote on the Clarity Act. That's the bill aiming to provide more structure to digital asset markets. That is now stalled because of a few conservative Republicans who want certain things added to that bill that the others don't necessarily want. Now, the big question now is whether Crypto Week ends up as a winning week for crypto investors, despite the fact that it's actually been a very good year so far. Let's bring in a big stakeholder in all this, an investor in cryptocurrencies, in the blockchain, and of course the founder of the first fiat-backed stablecoin, Tether. William Quigley joins us right now. And William, I am curious here. We talk about, I know we're focused a lot on these three bills working their way through Congress, but even before we got here, there was a lot of optimism in the crypto sphere, primarily because of the perceived support that the industry now seems to be getting from Washington.
That's correct. It's such a radical change from where we were a year ago, heck, even 6 months ago. The last 6 months, we have seen more on the legislative front than in the first 15 years of Bitcoin. And the most near-term piece of legislation that it appears will get signed, cross my fingers tomorrow, will be the Genius Act, which lays out a framework for companies that want to issue stablecoins, which is a very important part of crypto. And then you have two other pieces of legislation in the House, one of which I think is incredibly important. That's the Clarity Act. Mm-hmm. And what the Clarity Act does is it creates a framework for how the U.S. government and all of its agencies should think about crypto. We have been wanting this, those of us in this market, we've been wanting this for years. Yeah. And the Clarity Act is pretty good. If you look at how they define some very obscure technical things, they do a decent job. Obviously, it's the vote tomorrow that will take place on three pieces of legislation, the Genius Act, which the Senate approved, and then the other two pieces of legislation. Those other two are just in the House, so they'll have to go to the Senate. But it's good. But
I am curious about that third piece of legislation, which is the one that effectively would prevent the Fed or any government entity from effectively creating its own digital dollar, for lack of a better word. That seems to be the sticking point. I mean, some people want that included in the other bills. Are you for or against that?
Probably strangely to a lot of people in crypto, I don't have a big issue with central banks tokenizing their fiat and creating a central bank digital currency. I've long believed that all of the world's major economies are going to tokenize their currency and turn it into tradable tokenized assets in the next 10 years. Mm-hmm. I think it's impossible that won't happen because it's such a better way for money to be transmitted. Tether began that process, and now we're doing, many other companies are introducing stablecoins. I don't see why governments would not want to do it. The fear is that governments will then know everything you do with your money. Right. I just have news for people. The government already knows everything you do with your money.
Breaking news there. A lot of people talk about this bill and a lot of the legislation as a chance for regulation to catch up with innovation, ensuring that the U.S. dollar remains competitive in a digital world. On what front is regulation still far behind innovation? If that's where we're moving towards, the innovation continues to outstrip regulation. On what front is that still the most extreme?
Okay, in the clearest way where we have problems, there are two areas I would put in. One is this legislative ambiguity about which federal agency in the United States has supreme authority over crypto. The Clarity Act says it's the CFTC, the Commodity Futures Trading Commission. I support that. It should not be the SEC. The SEC has fumbled. They've done a terrible job. The SEC attempted to regulate via litigation. I don't think it worked. So that's one area where we still don't have a strict definition of the difference between a crypto and a security. The Clarity Act addresses that. And the other is really around banks and banks' willingness to work with companies that are involved in crypto. There's still a lot of problems with banks not really wanting to work with crypto companies because of, I think, they're concerned that they would have competition.
Yeah, and that goes back to not knowing who the primary regulator and who's in charge is as well. Bill, really appreciate your joining us. William Quigley is the co-founder of Tether and the decentralized marketplace Worldwide Asset Exchange. Coming up on the close, we're going to take you to the closing bell with Dana Doria. She is co-CIO at Envestnet. This is the close on Bloomberg.
If there were a serious effort to replace the Federal Reserve Chair before the end of the term, first of all, that is, we think, likely to be illegal. It would really call into question the entire institutional structure that undergirds the Treasury markets as being the safest asset in the world.
Lael Brainard, former vice chair for the Federal Reserve, kicking us off to the close just about 50 minutes ago, Scarlett. And of course, instead of this being a conversation today about earnings, it was all about Jay Powell's future and more importantly, the integrity of the Fed. And quite frankly, should we actually be cutting rates at this moment?
I mean, it caused a kerfuffle in the 11 a.m. hour for part of the 12 p.m. hour, but things have been pretty calm since about 12:45 p.m. And the S&P 500 is now at session highs, up by 0.3% after President Trump denied that he would look to fire Jay Powell.
Yeah, no doubt about it, though, that the pressure clearly is intensifying, whether it's coming directly from the White House or from other folks. And it gets to the question here, does this end up being that sort of maybe not black swan, but maybe that gray swan, that shock that a lot of people are saying the market is just a little bit too complacent about?
Yeah, a lot of people calling it a low probability but high impact event that would raise all kinds of existential questions. For now, you are seeing, of course, yields at the lower end, at the shorter end, go down. And of course, we continue to monitor volatility, which at one point you pointed out, the VIX got to 19.5.
Absolutely. There were some pretty extreme moves there. And we talk about the multiple standard deviations. We should also just point out for those folks who do have a Bloomberg terminal, our team at Bloomberg Economics, led by Anna Wong, they have a really great breakdown of the potential economic consequences should there be a forced removal of Jay Powell from his seat as Fed chair. Dana Doria joins us right now. She's co-chief investment officer over at Envestnet as we count you down to the closing bells with just about 8 minutes to go, Dana. And I do want to start off with the Fed and more importantly, just the perceptions about the integrity of the Fed's independence and their ability to make decisions about where they think interest rates should be based on the data and based on where that data points them. You still have confidence?
I do. I think Fed Chair Powell has demonstrated that he's not going to be moved by any kind of rhetoric. Let's be honest, right? This is not something that's brand new to these markets, right? A president trying to influence the Fed. I mean, we've seen this throughout history. I think sort of the drama that seems to accompany a lot of what this administration does, just the rhetoric, the language is always kind of loud. And, for markets that are maybe used to something a little bit more civility oriented, it can be tough to take. But I think Powell has kind of demonstrated that he'll sort of weather that and he's going to do what he's going to do. And I think for a lot of reasons, he's not going to budge. We're certainly not going to see anything in July, given the employment report we just saw, given the CPI, employment being stable, pretty solid report. CPI, not bad, but you're starting to see the impact of some of the tariffs. You're starting to see, appliances, right? Demonstrating some of this coming through. So I don't think Powell's going to do anything. I think he's going to stay the course. And my bet would be that the administration is not going to remove him.
Well, let's talk about the inflation side, too, because, what's kind of lost in the sauce is this idea that what the Fed's looking at and what we presume Trump is looking at are kind of two different things. Trump is much more focused on the fiscal fallout and whether a drop in interest rates could help him out, while the Fed is laser focused on inflation. As you were speaking, we're getting headlines from Raphael Bostic kind of saying what a lot of Fed members have been saying. We are starting to see the impacts of tariffs show up in the inflation reports. The full effect of that may not appear for months, probably into 2026. And as a result, they need to stand pat right now before they make any move up or down on rates. Are you comfortable with that?
I am. I think that's exactly where we stand. I think that really is, there's no BS in that statement, right? I think that's exactly where we stand. July's off the market. I think even September is questionable at this point. Again, remember the employment staying solid, and it wasn't a fantastic employment report, right? It's sort of people who have jobs are keeping the jobs. People who need jobs, they're not, they're not picking up jobs as fast as we might like. But employment staying stable. The Fed has two mandates, employment and inflation. You've got a stable, solid base with employment, and you've got inflation beginning to show the very signs that everybody's been afraid of, right? That these tariffs are, in fact, going to raise prices. So I think the Fed would be crazy to move any faster. And that's why, it's not like this thing is on the cusp, right? That there's, it could go one way or the other. So maybe, the political pressure is going to move them. I think it's pretty solidly in the territory of you got to wait.
Yeah.
So I think they will. I think, yeah, go ahead.
No. I think those are all important points. I'm curious, as we look at the market reaction, you could even call it fallout, with the twist steepening taking place in fixed income, the 530s curve now at the widest since 2021. What are the implications for valuing stocks when we see that persist?
Yeah, I mean, that's one way to value stocks, right, is, of course, to look at interest rates and, discount rates. I mean, I think we've seen for a while that some of that is not necessarily in place. I mean, look at just the performance of growth stocks in the last several years and the fact that interest rates had to increase dramatically, but it really didn't hurt, the valuation of growth stocks the way you would expect. Growth stocks, obviously, long dated cash flows. They have a lot of years you have to value back, so you're discounting at those higher rates for a lot longer. But you still didn't see, and part of that is because they are able to fund themselves, especially the big guys, with their own cash. They don't have to go back to markets. Where this kind of hurts, of course, and has been the case, is small caps. Yeah. Small caps tend to be more interest rate sensitive. They do have to go back to capital markets. So I think it could continue to be a rocky ride, and you've seen that in the difference between how international small caps have been performing this year versus U.S., right? Internationally, we've seen rates come down, and they've done better. We know the Fed probably would have lowered rates if it weren't for the tariff impacts, but it is the case, right? We have this. We kind of have to deal with it, and we've seen the debacle on that came after Liberation Day. Trump, I think, demonstrated that. I don't know if the equity markets move him so much, but he does. He's a real estate guy, and he does, I think, pay attention to that 10-year. Right. I mean, the bond market, I think he does have respect for. And, you saw just today, the bond market reacted pretty quickly at the notion that Powell could be removed. Right. So, I don't think he's going to go ahead and try to remove Powell.
Dana, very quickly, which sector's earnings are you looking forward to the most in terms of getting visibility on where things stand when it comes to the economic impact from tariffs?
Yeah, it was interesting to see what's going on with financials and the trading revenue being up because everybody's hedging against the volatility. I thought that was a pretty telling sign. But, I think let's face it, we have retail investors very heavily concentrated in the biggest, growthiest stocks. So you have to focus there because that's where money's sitting, like it or not, right? That's what all of our retirements are kind of sitting on. So that's where the focus is, right? The big communications, the big tech.
All right, Dana, great stuff. Dana D'Auria, Co-Chief Investment Officer over at Envestnet, counting us down to the closing bells with just about 2.5 minutes to go. We should point out, with the S&P at 6264 and change right now, we're actually at a higher level than where we were before those headlines started to move just before lunchtime regarding Jay Powell's future and the idea that Trump maybe is intensifying his campaign to remove him.
It really goes to show how much investors have learned to shrug off a lot of this political noise that's taking place. Absolutely.
So most of those gains and losses, depending on the direction, have been retraced as we move closer to the closing bells, and a market now, at least for some of the indices, poised for a record high. Our global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu, taking you through to that closing bell with the global simulcast. It starts right now. Tim Stenovec in the radio booth. Isabel Lee in today for Carol Massar. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube on what, surprisingly, Tim Stenovec, could be a record-setting day.
It could be. I think surprising given what we heard about the reports this morning about Fed Chair Jay Powell. I think that, any other day, the focus would be like we'd be talking about big bank earnings, maybe United earnings after the bell. But the focus for us for much of the day has been, will he or won't he, when it comes to the president and Jay Powell?
But it's interesting. How much would you put credence on the comment, on the pressures of the comment today? Because we really have a Fed chair who's really just trying to keep his job, but a president who's really trying to test the markets and see the market reaction.
Yeah, and he did test the markets, and then, of course, he denied the report, which allowed equity investors to kind of look past everything and push indexes to the highs of the session right now. So the focus comes back to companies and what they tell us about what they're seeing and how they're positioning themselves amid all this uncertainty.
And so far, the earnings, I know we're very, very early in the earnings season, but so far it has been relatively encouraging. No one is really basically basically saying, look, things are going to fall off a cliff. We just had an interview with the CEO of Prologis, the biggest warehouse REIT in the United States, and he did suggest there are some pressures when it comes to tariffs, immigration, and other things, but overall, business is still good, and he still sees consumers still spending. As we get the closing bells here in New York, it is green across the screen here on this Wednesday afternoon. And despite all of the intraday ructions that we saw earlier in the session that took stocks from green into the red, we are firmly back in the green almost across the board. The Dow Jones Industrial Average up 0.5 percentage point on the day. The S&P up 0.3% on the day. The NASDAQ Composite up 0.3% on the day. And the NASDAQ 100 closing out at a record high, up about 0.1% on the day. The Russell 2000, that's going to be your main outperformer on the index basis, up 1% on the day. Now, we are, of course, getting some earnings as well, including from United. That's just crossing the wire right now. Let's get right to it as we see those shares bounce around in the after-hours trade, with the company saying second quarter adjusted EPS coming in at $3.87 a share. That's a beat of about 3 cents. As far as revenue, the company basically does say that the revenue did come in above estimates, with operating revenue at $15.2 billion and passenger revenue at $13.84, though we should point out passenger revenue is a slight miss. The Street was looking for 13.92. The guidance for the third quarter, the current quarter that we're in right now, adjusted EPS 225 to 275. That's the range the company is giving. The high end of that range, 275, is above the average of Street estimates for $2.65 a share.
And we're seeing shares of United kind of bounce around. They were down about 1%, now slightly higher as well. Well, when you look at that guidance, what strikes me is that the full year adjusted EPS of $9 to $11, the midpoint of that is higher than the consensus estimate. But when you look at what they have for this quarter, the third quarter, that is a little bit lighter than what analysts had been anticipating. So perhaps things getting pushed out to the fourth quarter rather than seeing any kind of blue skies immediately.
Some really interesting commentary in the press release. The company saying that beginning in early July, United has seen a sequential 6-point acceleration in demand and a double-digit acceleration in business demand versus the second quarter. The airline attributes this to less geopolitical and macroeconomic uncertainty and has updated its full-year adjusted diluted EPS guidance to $9 to $11, underscoring the resilience of United's brand-loyal, revenue-diverse business model. The company also said that in June, United at Newark, and this was a big question given the challenges that Newark had, they said they led all other major airlines in on-time performance and lowest seat cancellation rate at all New York City area airports.
I'm curious to know, are airline valuations attractive at current price multiples, or are some carriers better positioned, like Alaska or legacy carriers like United? And how are airlines managing non-fuel costs, like labor, maintenance, loyalty programs, which we all love? And lastly, is technology, especially AI, really helping?
Yeah, these are all good questions, and these are all things that strategically investors will want answers to. But in the immediate here and now, the focus is going to be on the fact that this full-year adjusted EPS is a lowered range than what it had previously seen, $9 to $11, whereas previously it expected $11.50 to $13.50. So again, keeping an eye on those shares. As for the trade today on Wednesday, it was a really interesting day because the S&P 500 was bouncing around, but in the last 2 or 3 hours, we saw a steady rise higher. And by the end of the day, look at the IMAP. You only have 3 sectors in the red. Energy stocks down about 0.8%, and communication services and consumer discretionary, basically little changed. Healthcare, REITs, and financials were your top gainers on the day.
All right, I had quite a few gainers to choose from. I want to start with Johnson & Johnson, one of the best performing stocks in the S&P 500. The company beat sales expectations and raised its full-year outlook. It showed confidence even as the pharmaceutical industry faces threats of tariffs and a crackdown on drug pricing. Shares higher today by about 6.2%. The company increased the midpoint of its 2025 revenue projection. It raised the midpoint of its full-year adjusted earnings outlook. Sales in the quarter reached $23.7 billion. That was ahead of the average estimate from analysts. Also, watching what happened with asset management stocks today. In general, they moved higher, including Apollo Global Management. The Trump administration finalized an executive order that would pave the way for 401k retirement savings plans to invest in private equity. This, according to people familiar with the matter. Shares of Apollo, ticker APO, up 4.8% today. And finally, quantum computing stock, Rigetti Computing. It's typically among the most actively traded stocks, but even for a stock that's actively traded regularly, this was a day of outperformance. Shares surged today more than 30%. This after the company said in a press release that it succeeded in demonstrating the largest multi-chip quantum computer in the industry. This milestone is a 2x reduction in the median 2-qubit gate error rate from previous best results in its 84-qubit single-chip Anka 3 system. I don't know exactly what that means, but investors were pretty excited about it.
Let's not have
I was going to have you translate it for me, Romain. I know you're like big into these quantum stocks.
Yeah, I am actually.
I know.
Okay, so now it's time for decliners. We have Ford down by 2.5%. The car maker says it is recalling almost 700,000 vehicles to address a long-running issue over cracking in an auto part that can leak fuel into the engine and cause fire. So the action applies to a certain Bronco Sport and Escape models from 2020 to 2024. Next, we have Bank of America. Ticker is BAC. Shares are kind of flat, but down by 0.2%. So the stock edged between gains and losses, but ended in the red. We have the bank reporting trading revenue that beat analyst estimates, but we have Evercore saying that the result was largely in line and not overly exciting, with trading revenue better than expected and tax rate lower than expected. And last, we have Amazon. So lots of headline for this stock. It's down by 1.5%. Amazon carbon emissions rose for the first time in 3 years in 2024. We have environmental watchdogs really watching this key metric. CrowdStrike also expanded its collaboration with AWS. And lastly, the third headline for Amazon, Cantor Fitzgerald raising their target on Amazon to $260 from $240.
All right, let's check in on yields, because it was a really interesting day. We talk about the idea that a lot of the knee-jerk reaction to some of those headlines on Powell's did get reversed. Not necessarily so when it comes to the Treasury market. You did see yields go down across the board, but what is interesting, you actually saw the yield curve steepen for a fourth straight session, and it's a significant steepening as well, because you talk about this idea here that with a lot of this now weighted back towards the front end of the curve, what exactly are investors pricing in? They may not be fearful of Powell being removed prior to his May 2026 term ending, but they are concerned about how the political pressure might influence the decisions going forward and the decisions after, and what that might mean for inflation.
Okay, you're talking about the bond market and Jay Powell. I'm talking video games here and GameStop. Did you guys see what GameStop ended up doing, given there were some problems with the new Nintendo Switch 2?
Yeah, I saw this. So, so some knucklehead decided that he was just going to staple the receipts like directly onto the box.
Yeah, and what it ended up doing was puncturing the screen.
Yes. Right.
And because this is 2025 and we live in a world of social media.
Did he not know that there was an expensive device inside that box?
Well, not all is lost here.
Okay.
What ended up happening was they ended up auctioning this off. GameStop did.
Wonderful.
$250,000.
Cool.
On eBay compared to a new one, which would cost just $500. Wow. And yes, creating another viral moment for a company.
Wait, why is a punctured one worth so much?
Maybe because GameStop got involved. Ryan Cohen got involved.
Yeah, but it's not like there's anything beyond that, just because it was in a viral moment.
He said it turned into a collectible, and now it's dubbed
collectible.
Staplegate.
He also said, he tweeted it out. He said, if this reaches 6 figures, I will include my underwear.
Wonderful.
And it did reach 6 figures.
Wow.
Wonderful.
They know how to make a moment.
Do I want to? Never mind.
You can see the punctures there in the screen.
Yeah.
You know, it was actually hard to see. It didn't seem like that big of a deal.
You know, I had to
would have just returned
it too. When I saw the story, I was like, what? But,
yeah, I really had to struggle hard to see where the staple hit. It's not like it cracked the screen or anything.
You know what? Just put that right next to your Bored Ape picture and your the banana taped to the wall and whatever other nonsense that we're spending our money on these days.
That is the world we live in.
You weren't the one who bid on this, Isabel, were you?
We got to go, guys. That's going to do it for our cross-platform coverage.
Speak for Isabel.
Of the market close. And of United earnings, which we are continuing with on Bloomberg Radio in just a minute. We'll see you guys tomorrow, same time, same place.
And stick with us here on The Close. When we come back, a deeper dive into those earnings out of United Airlines, and we're on watch for earnings out of Alcoa. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romain Bostic here, taking a look at how markets finished out the day. And it was quite a day. We actually opened higher, moved quickly lower on some of those headlines about the potential for Jay Powell to be replaced, but markets found their mojo late in the session and managed to close out higher than where they were before those headlines crossed the wire. The S&P 500 up about 0.3% on the day. The NASDAQ 100 only up 0.1%, but that was good enough for a record high. You did see a lot more activity in the FX and in the Treasury space. Treasury yields across the curve did move lower, while the dollar did finish the day lower by about 0.3%, and that spike in the VIX almost up to 20, retreating back down to that 17 level. On an individual basis, chip stocks really were on the back foot all day long, and that's out of, we got some reports from the European chip design company ASML that seemed to put a chill over that space. Back here in the U.S., there was a chill over the healthcare space as well. HCA down about 2.5%. Centene and quite a few other competitors in that space also moving lower as people continue to parse that big, beautiful tax and budget bill and maybe the potential negative impact on that part of the sector. Meanwhile, Circle and some of the crypto companies getting a pretty big bid on the day, as maybe there is progress going on with regards to that legislation that could provide more clarity for the industry. All right, that brings us to our top story of the day, and that is a closer look at the corporate earnings picture. This morning, we got Goldman Sachs and Bank of America posting record-setting trading revenues. Yet the share reaction, as you can see there, decidedly tepid. A beat on net premium revenue at insurance company Progressive. Well, that was shown a bit more love by markets, as it was for warehouse company Prologis, which said demand is holding steady, and as it was for J&J, which lifted its full-year outlook on medical device strength. Now, the new earnings season is just days old, but we're already getting some really good insight. And tomorrow we're going to get more signals from GE, Pepsi, Cintas, and Netflix among the notables. And here today in the after hours trade, we also continue to get updates. Just a few moments ago, we got earnings out of Alcoa. Those shares moving higher in the after hours session after the company's adjusted EPS did come in line with estimates, adjusted EBITDA beating. But more importantly, the company providing guidance that seemed to suggest that shipments will hold up. Aluminum production expected to be in the 9.5 to 9.7 million metric ton range, which is right around what the street was looking for. Shipments also expected to be around 13.1 to 13.3 million metric tons, also right around what the street was looking for. Meanwhile, we also got earnings out of United Airlines, and you can see the earnings there are down, despite the company narrowing its full-year adjusted earnings outlook just a bit here. It did keep people a little bit of pause. Some concerns here that range is still a bit too wide, and concerns about whether the company will be able to meet it. Full-year adjusted earnings of $9 to $11 per share is what the company gave us. Barbara Doran joins us right now to give us her take. She's founder and CEO at BD8 Capital Partners, and she's been an investor in the airline space for quite some time. Barb, great to have you here on the program. When we were talking on the show the other day about Delta's earnings, now taking a look at United, there is this sense here that travel, certainly on the leisure side, is holding up in a way that I think some people over the last couple of months thought might potentially collapse.
Yeah, no, I think there's been a lot of concern, and that really, I think, stems from the tariff uncertainty, where a lot of estimates have been that it would slow down economic growth, it would raise inflation. And so far, we haven't seen much of that, but there's I think, pretty much a consensus feeling that will flow through. And so, of course, airlines are discretionary travel. And what we are seeing domestically, we are seeing a bit of a slowdown. You're seeing capacity reduction across the board, but international travel, the higher income consumer and for business travel is holding up. And that's really what happened last week with Delta. And United moved in tandem because the premium seats were up, the international seats were up, and those are much higher profitability than the main cabin. So it looks like travel is holding up but weakening the margin. And certainly you saw that this morning, the PPI number, that there was weakness in the travel services and lodging connected to that. So I think that the United, we talk about that year range, it's they had given two forecasts back in April when most airlines withdrew their guidance because of the sudden uncertainty with the tariffs, and they had the recession outlook, which was a $7 to $9, and they had the okay outlook, which was 11.50 to 13. So this new forecast is right in the middle of that. And we're going to hear tomorrow when they have their earnings call, just is how much is that a conservative assumptions and carefulness about the macro environment.
I am curious about what you think about the pricing power for the airlines, at least the big U.S.-based airlines, particularly as we head into the busy travel season in the fall and winter. Do you think they still have it, or are we going to see maybe a little bit more discounting as they try to compete?
I think we're going to see a little more discount, and you're already seeing that pricing has softened, particularly again in the domestic routes. And certainly we're heading into this last month or two of the summer season, very strong international travel, at least from our end. I mean, we are seeing weaker foreign travel to us, for lots of reasons, but I think a lot to do with the uncertainty, in our politics. But I think you will see discounting start to happen. I think, a little bit at first, they'll reduce capacity. But I think that is probably inevitable because you're seeing, wages, and that was the most recent numbers. Wages are right now not growing faster than inflation. Mm-hmm. People still have jobs, but that is weakening on the margin. And of course, it will show up in the most discretionary items, and travel's a big one.
I am curious about when you look at the valuations of some of these airlines, and I know they're well off their highs, but they've had a pretty phenomenal run over the last couple of months. I am curious if you find true value in some of those names, if at all.
Well, I think last year they were a lot more attractive in valuation. And certainly there was a lot stronger demand in terms of, still this post-COVID. But valuations, because are never going to be high. They're both, United, Delta around an 8 to 9 PE. But these still are very cyclical names, despite there basically being an oligopoly. It's still very dependent on economic cycles. And so I don't think they are, the question is, will they get back to their old highs, which would mean there is room to go. But I think it's a different environment this year where demand is not as certain as it was last year and valuations are higher. So I don't think there's perhaps a lot of room to run on the airlines.
All right, Barb, really appreciate you taking the time for us. Barbara Doran, founder and CIO at BD8 Capital Partners. A closer look at those earnings out of United Airlines. The shares down about 4% in the after-hours trade. When we come back, though, we go to the big story of the day, and that's the escalating pressure on Jay Powell. We talk to former Fed Governor Betsy Duke when we come back after the break. This is The Close on Bloomberg. Well, the Trump-Powell saga continued today in a big way. First, there were a series of reports saying that President Trump was indeed planning to fire Fed Chair Jay Powell. Trump himself, though, refuted those reports, saying that, well, the idea that it had been raised in a closed-door meeting with congressional Republicans, in his words, he said, that just wasn't necessarily true. It's something that's been discussed in his words, but not something that he's actually going to act on. Nevertheless, the market reacted to it in a very big way, and there are a lot of concerns going forward as to whether Jay Powell can indeed fulfill his tenure, which would officially end under normal circumstances in May of 2026. Let's bring in former Fed Governor and former Chair of Wells Fargo, Betsy Duke, to talk a little bit more about this. And Betsy, there's a big question right now. It's not so much if Jay Powell would be removed, but if there was a formal effort to try to remove him, just how much impact that would have on the markets and really, quite frankly, just in the perception about the U.S. economy.
Well, you saw a little bit today. You've seen it at other times. Just a discussion that Powell might try to unseat Jay Powell sends markets screaming in bad directions. So, there's nothing to be gained by talking about it. There's nothing to be gained by threatening it. It's not something that he's going to threaten Jay and Jay's going to all of a sudden resign. That's just not going to happen. So any talk of it really disrupts markets and doesn't accomplish anything.
There's been a lot of talk about this idea of where interest rates should be. And I know that the administration has tried to sort of make the case, not just that Jay Powell might be late to the game, but the idea that there might be some sort of structural deficiencies in the way that the Fed has made its decisions over the course of his tenure. And I am curious as to what you think about his track record since he's been chair of the Fed, some of the mistakes that he's made, and there's obviously been one big one, but also some of the successes that he might have had along the way.
So I think Jay's been a terrific chairman. I think he's been one of the best that I've seen, and I've been following the Fed ever since before Volcker, actually. So he managed through the through the pandemic really, really well. The sort of transitory issue and being late to raise rates is certainly the biggest error that he made. But that was an error in judgment, not an error in methodology. They thought it would be transitory because it was due to supply shocks, and the supply shocks ended up being longer and more persistent than anybody expected. But those have now generally settled themselves back out. You could have the same argument about tariffs, that once tariffs come in place, will the effect of those be transitory or not? And so, the Fed may be a little bit gun shy about the idea of something transitory and therefore slower to lower rates in the face of tariffs.
While there is so much pressure right now on this idea that of him potentially leaving early, one way or the other, he's gone in less than 12 months. So there's certainly a justification for at least having an honest conversation about who would potentially replace him. When you look at some of the names bandied about, the Kevin Hassett's, Kevin Warsh's, Christopher Waller, and I think even Scott Bessent himself might actually be in the running. Do you look at those candidates, at least the ones we know about publicly, as being suitable replacements for Jay Powell?
So all of those candidates have the requisite credentials and would certainly be acceptable as chairs of the Fed, and then how they actually operated would be something that would come forward. But he has said, President Trump has said that he wants a Fed chairman who will agree to lower rates, and lower rates regardless of what's going on in the economy. And I don't think anybody who is willing to make that promise politically is an appropriate chairman for the Fed.
Do you think, though, the president would actually even appoint someone who wasn't willing to make that pledge, whether it's to him personally or publicly when they go before Congress for their hearings?
Yeah. I mean that is really, really a tricky situation for anybody who's likely to become the chairman or be nominated as the chairman, because they would get into hearings and they would be asked that and are going to have to answer honestly. So I think that's going to be difficult. I would say of that group, the one who's probably in the trickiest position is Waller, because he is on the Fed board now. And so he will be recording votes from now until all the way through.
There have been a lot of people talking about what could become of this, particularly if it is contentious, if Jay Powell were removed as Fed chair and for whatever reason decided to stick around on the board itself through 2028, which he would allowed to actually do. And there have been a lot of comparisons to William Miller's term, George Miller's term, I should say, back in the 70s, and the idea that you had a Fed chair who came into an organization that, let's just say, to put it diplomatically, wasn't necessarily well received. And of course, he was gone in pretty short order, not fired, but they certainly found another job for him. And I do wonder if we could find ourselves in a repeat of that type of situation.
You could find yourself in a repeat of that situation, but the question is whether or not, how difficult it would be to change horses then, how difficult it would be to get a new chairman, especially if the president didn't agree that it was somebody who ought to be removed. So that removing a chairman who doesn't want to leave is going to be incredibly difficult. It's not going to happen overnight. It's not going to happen in any short term. Mm-hmm. It's going to be fought through the courts for quite vigorously. So it's not going to happen in the short term. The second thing is, even if you remove the chairman, you've got a FOMC, you've got a committee that seems pretty well settled on where they're headed. And even though you've sort of got two camps, the no drop in rates and the 50 basis point drop in rates, other than that, they seem to be on the same page. So I don't see any fracturing going on in the committee itself. And so anybody who comes in is not only going to have to decide which way they're going, but they're going to have to bring enough of the committee along to win the votes. Yeah, well said. Betsy, always wonderful talking to you. Betsy Duke, former Fed governor, former chair over at Wells Fargo. All right, still ahead when we come back, we're going to talk about what the spat with Jay Powell actually could mean for both public and for private markets. Sunaina Sinha is Global Head of Private Capital Advisory at Raymond James. She comes up next on The Close.
Well, President Donald Trump says he's not planning to fire Fed Chair Jay Powell. Markets, though, well, they've moved back and forth on a lot of the comments coming out of the president himself and coming out of various news reports. They did end the day in the green, but it's raising a lot of questions about the potential impact on markets, both public and private. For the private side of the conversation, let's bring in Sunaina Sinha, Global Head of Private Capital Advisory at Raymond James. All right, Sunaina, I'm sure you saw some of the drama here. And look, we can sort of look through the political noise, but underneath it, there is a fundamental argument going on right now about where rates should be, and more importantly, whether the Fed should be operating at the behest of fiscal policy and what the president is doing, or whether they stick to their dual mandate and keep a laser focus on inflation and the labor market.
I think for all markets, including private markets, having an independent Fed that makes decisions the right way about inflation and unemployment is absolutely critical. It's important to policy stability, market stability. You see that in the reaction today, and you've seen that throughout every time he signals to go this way. So with respect to private markets, especially private equity, having rate stability matters even more than just having lower rates. Of course, private markets benefit from lower rates, but not at the expense of inflation. When we had the inflation spike, you had the inability for any M&A to take place because nobody could price where goods were going to come out because no one knew where the top was for inflation numbers and for the rates, therefore. So policy stability, focus on inflation, and then unemployment, absolutely critical for all markets.
I'm glad you made the word stability, because I think at the start of this year, at the start of this presidency, we should point out, there was a lot of instability, and we kind of saw markets frozen up, both public and private market, but certainly in the private markets. And then it seemed like the sun just came out and things started to open up once it became a little clearer about the texture of these policies and whether we can live with them. When you look at some of the M&A activity that we started to see, and the deal activity overall, I should say, that we started to see late April, into May, and into June, do you think that's sustainable? You think there's legs to that going through the rest of the year?
Only if there aren't many exogenous shocks from policy narratives that the market doesn't expect. So we've started to see green shoots again in June and coming into July, given the fact that markets now look through tariffs, whether we call it TACA, whether we call it somewhere else. We're at tariff levels where the market said we can price this. We can price this into our companies. Companies started issuing guidances, both public and private, which investors could say, I can use this to do a deal. Unfortunately, what we have now is more uncertainty with what happens in early August, with the expiration of the latest rounds, what happens in the geopolitical fray, what happens with Fed Chairman Jay Powell. All of this causes investors to go back on their heels and say, I don't need to do anything right now. I can watch and wait. So we've seen green shoots appear both in M&A deal making, but also in the IPO markets.
The deals that are getting done right now, are these deals that kind of had to get done, meaning like the clock was just ticking, or are these deals that were really just like, hey, we feel like the environment's right and we can do this?
The deals that are getting done so far this year are pristine assets. These are companies that are just the best high flyer trophy assets. They're getting sold because they would get sold anyway. There's a lot of private equity players, a lot of private market assets that are holding on to companies that are more mediocre. They were bought at very high valuations at the peak of the 2020, 2021 deal-making period. And the industry does have an aged assets liquidity problem that is being solved in a few different ways through the secondary market in private equity, which is absolutely booming at the moment, being a very natural way for exits to take place. But unfortunately, not enough M&A and not enough IPO activity yet to clear those assets.
Well, with regards to the age assets, I mean, we talk about, limited partners have been grousing for a while, saying that, look, you're coming back to us to fundraise for a next round. Meanwhile, the last round that we invested in, we haven't actually gotten our money back yet. Have secondaries actually helped to sort of soften that blow a little bit, or is that just kind of window dressing?
Secondaries have definitely helped soften the blow, but the private equity secondaries market is a drop in the ocean compared to the primary market. Primary market, $3.5 trillion of assets sitting in the balance sheet. Secondaries market about to approach $200 billion annually. So you can imagine the scale. It's definitely there to help, but it doesn't take into account the immense amount of liquidity that needs to come out of the private markets. Remember, private equity, as you rightfully said, works on a clock. 4 to 5 years to do deal, so then sell deals over the next 4 to 5 years. And that liquidity cycle of distributions back to limited partners is suffering at the moment, and it needs to clear.
When I was looking through the league tables on the Bloomberg terminal, I was kind of surprised at how many deals we've seen involving public, one company being public, one being private. And I'm curious if that becomes a little bit more of the trend, or do you think we'll see more private tie-ups?
I think you'll definitely always see a lot of private tie-ups, but you're seeing a lot more public-private tie-ups. There is this sense of, if I don't need to be public, why am I public? And what are the public markets giving me because of all the increased governance, compliance, and costs associated with it? It is private for longer, still remains the mantra. That's where companies would prefer to be. But eventually, if you're being held by a private equity player, a growth or venture player, you need to be sold.
When you look at the private equity, private capital landscape overall, obviously this is a market globally that's been dominated by the U.S. Are you seeing more activity in Europe and other parts of the globe, or is this still a U.S. story?
We're seeing a lot more activity in Europe compared to the years prior. A lot more interest in Europe because of policy and macro stability there. And the ability to price assets, Europe can still have companies that are regional champions that don't have a lot of beta to the U.S. or to tariffs. And so you've seen a record number of public to private transactions in Europe, to your earlier point, and just a lot more M&A activity in Europe versus U.S. versus prior years on a relative basis, because of that entire picture, that geopolitical macro picture where there's more policy instability here.
All right, so overall, you're still hopeful for the long term?
We live in hope, Romain. No banker will tell you otherwise.
Right, not publicly. Sunaina, great to have you. Sunaina Sinha, Global Head of Private Capital Advisory over at Raymond James, as we continue moving forward on the close with a quick look back at how we did close out the day 36 minutes ago, with the S&P squeaking out a modest gain on the day, despite the shock that we had in the middle of the day on those Powell headlines. Yields across the curve did move lower, so too did the dollar and the VIX, which spiked close to 20 on the day, settling back down around 17. This is the close on Bloomberg. All right, well, probably the only person on Wall Street talked about more than Jay Powell right now is New York City mayoral candidate Doran Mamdani. He met with roughly 100 business leaders ranging from technology to pharmaceuticals, and it's a meeting of one of several scheduled between the Democratic nominee and the business community, a business community that has been on edge since his surprise of victory in the most recent primary election here in New York City. A lot of questions here about the young and charismatic leader and whether he can translate his success on the campaign trail into actually being a competent administrative mayor. One of the business leaders at yesterday's event is Charles Phillips. He's managing partner and founder of Recognize, and of course also has an affiliation here with Bloomberg LP. Great to have you, Charles.
Good to see you again.
So you were in the room. You actually had a couple of chances to meet with him. And let's face it, a lot of people weren't paying a whole lot of attention to Mamdani just a couple of months ago. And I'll put myself in that camp. A lot of us woke up and were shocked to see not only that he won, but by the margin of victory that he did. A lot of questions right now about a lot of these lofty things that he wants to do. They're going to cost a lot of money, and a lot of concerns about some of his rhetoric as it relates to Wall Street and the business community. Did you leave those meetings feeling better about him than you did going in?
Well, I will say he's very personable and engaging. He started off the meeting saying, "I'm sorry you're seeing my face on the New York Post every day. I know you're getting tired of seeing my face," but so he makes jokes about himself, very self-deprecating. But I can see why he's in the position he's in. He was articulate, smiled a lot, engaging. I would say people liked him just as a person. I don't think they were persuaded on actually what he had to say that much in terms of actual policies. Some of his numbers didn't quite add up. Some of the economic logic behind it didn't, resonate. But these are business people, so they know the numbers and know it doesn't work. We know how markets work. So nonetheless, I don't think he persuaded a lot of people, but they respected that he came there and spoke to them directly. Answered most of the questions. Some of it was very long-winded. Some of it was, typical politician speaks well. You're not sure if he answered the question or not. But he's good at it. He's very good at it and likable.
A hypothetical, and just, for folks watching that don't understand how New York works, it's obviously a Democratic city, so the primary kind of sets the tone. But he's still going to have to face off against Cuomo, the former governor of New York, and Eric Adams, the current mayor of New York, both Democrats who are going to be running as independents. If we assume for a second that Mamdani does win in the general election against them, can the business community live with him? I know they may not like him, but do you think they can still work with him and live with him for 4 years?
Well, first of all, we've never had a general election like this. We have a sitting mayor and a former governor running as independents. Remember, we have almost 5 million people registered to vote. They usually don't vote, but they might because so many famous names are out there. So if one of them were to beat Mamdani, it would be the independents. We got about 1 million of those, a little over 1 million actually, and the Republicans, about 500,000 of those. I don't know how they're going to vote. That's the path. If he wins, however, I do think the business world would work with him. They'd have to. You also have to keep in mind, most of the things he has proposed, he has no legal authority to do. The MTA is the only one that can give you free buses. The state controls the tax rates for businesses and personal tax rates. He has some influence on property taxes, but the city council has to approve that. The free rent thing is the Rent Guidelines Board. So the mayor of New York only has a limited amount of power, but he can influence people. Maybe he can persuade on some of these things.
I am curious just about from your perspective as an investor. I mean, we introduced you obviously at Recognize, and I know you guys just over at Recognize just had a new funding round. Was it 1.7?
We raised another 1.7, have about 3.5 billion under management now.
So a lot of money, obviously a lot of money you have to put to work. I am curious, just when you look at New York City, I mean, you're based here more or less, and I am curious as to whether you view New York as investable, whether it's real estate or anything else. Is it an investable place?
It is. Yeah. It's still the most attractive city in the country, in my view. Young, aggressive people still want to come here. We have our limitations, though. The taxes are the highest in the country for sure, business and personal. Our budget is over $13,000 per capita in this city. The rest of the country is around $2,500 in any other city, including LA. So we spend a lot, we tax a lot, but we attract people who want to do great things. And that ambition, as long as we still have that, we'll create new millionaires.
All right. Well, with regards to your new fund, I am curious about where you are going to try to deploy that money. I know you've been obviously a big investor in the tech space, particularly given your background. What do you find attractive right now?
So our fund called Recognize is hyper-focused on one area, is digital and AI services. So these are the companies that essentially, the services companies that take new inventions, whether it's AI or something else, and implement it in a real customer. Critical link between the innovation and actually the end user. So that's what these companies do. So we have companies in the Google ecosystem, cybersecurity, things like that, as well as AI is obviously booming. The good thing about right now is when you have a big tech trend that everybody's talking about, and every board of directors wants to know about, every CEO feels like he has to do something, that's very good for these companies. There were 40 deals just last week in this one sector. Wow. Most of that went to strategics trying to catch up, buying companies that we create. And so it's a hot time to be in the sector, and you always need some driver of change, and we have it now.
What's the pricing look like though, too? I mean, you hear some of these wild numbers, Meta paying, just a single AI engineer a $200 million pay package over time. Are those numbers real that we're seeing out there?
That's a super specific segment of the market. No, that's not real for most of the companies. But for the geniuses that he needs to hire to catch up and try to reach OpenAI, he needs that.
When you look at the spend on AI spend overall, and the idea that there are companies that are clearly just splashing the cash anywhere they can, do you think that maybe some of that money might be misdirected?
There's always that chance. One of the areas we're investing is data center maintenance. So the companies that manage your data center, build it out, do the repurposing of equipment, refurbish it. And so there's so many data centers being built right now. But the models are getting bigger and bigger. You can see what Elon just did with XAI. And so it looks like this trend is going to be with us for a while. Always some risk we overdo it, and we usually do at some point. But right now, it's being used.
When you look at valuations, particularly for the private companies out there, do you think the valuations are appropriate? And even for the public companies, because there's been a big debate here when you look at valuations, even on NVIDIA or Microsoft or whatever, the idea that they've gotten so far ahead of themselves. But then people would argue, well, when you look at the potential benefit from all this AI investment, it'll all somehow catch up.
Yeah, I talk about this with my old colleague, Mary Meeker. We used to work together back at Morgan Stanley. And she reminds us that it took 10 years for Netflix to get to 100 million users. And it took, I think, 10 months for OpenAI to do that. So that's the difference that we're talking about. The level of adoption of interest in this is much bigger than people think. Usually when these trends happen, it takes a while for them to get started. You're slow, you're not sure if it's working, but then it ends up being much larger than you think down the road. That's what's happening on the internet and many other trends.
Well, I'm just curious. Well, compare that too, because I mean, you're early in your career. I mean, you were knee deep in, I guess, what at the time was this big boom in software, particularly SaaS and all the things that now are just common, part of our common conversation now. Are there parallels between what you saw back then and what you're seeing today?
There are, and the easier thing that's happening now is it's easy to adopt AI. We all have used it, hundreds of millions of people around the world. To get 90% of the users outside of the US, it took the internet about 35 years to do that. And it took OpenAI about 35 days. So it's when a technology is so popular, it gets natural adoption and everybody gets educated on it, it can go a long way. And so they did it the right way by broad-based adoption, familiarize everybody with it, and now let's get the enterprise use.
All right, Charles, I always appreciate it. Charles Phillips, he's managing partner and founder of recognize. All right, stick with us. We'll be back in a second here to set you up for what to watch over the next 24 hours, and that includes an earnings report from Netflix. This is Bloomberg. All right, let's take a look back at this day in history. 30 years ago, when Amazon.com went live to the public for the first time ever. Now, while the company had been founded a year earlier, it was on this day, July 16, 1995, when Amazon made its first sale to the public, a book on computer models called Fluid Concepts and Creative Analogies. Yeah, snoozer. The book was technically ordered in April of that year but for $27.95, but Amazon didn't actually log the sale officially until July 16th. The man who bought it, software engineer John Wainwright, well, he said in interviews that he only signed up for Amazon at the urging of a friend who worked there, and he actually thought he was getting the book for free until he saw his credit card had been charged. We've all been there, John. Nevertheless, this accidental sale, if you will, is now legend. Amazon went public less than 2 years later, soaring immediately to give the company a market value of $1.3 billion by year end, despite revenue of less than $100 million. But it's hard to understate the value creation that's occurred since. The shares have returned an annual equivalent of about 32% since. That's more than 3 times the annual equivalent return for the S&P and even exceeds Microsoft's healthy but still lagging 24% average return since 1986 and Apple's 20% average since its IPO. Now, a big part of Amazon's outperformance is the relentless growth strategy that had been pushed under Jeff Bezos. What started out as a bookstore quickly morphed into a broad retail platform with the launch 25 years ago of its third-party seller business marketplace. That success begat other successes, ventures into electronic devices like the Kindle and Echo, film and TV production, and now the monumental decision back in 2002 to start renting out computer power on its servers to other web companies, a web services business that is now the company's biggest profit driver. Now, it's anyone's bet what comes next for the company that last year reached a $2 trillion stock market valuation, a far cry from the company's start 30 years ago today as a lowly bookseller. All right, so we go from one big company to another, and we should point out only one of the few tech companies out there to actually outperform Amazon over the years has been Netflix, an average annual return of more than 36%. And that company is scheduled to report earnings after the bell tomorrow. Investors are expecting that quarter, the second quarter, to be its most profitable quarter ever. Joining us right now to talk a little bit more about what to expect is Alicia Reese, Senior Vice President of Equity Research over at Wedbush Securities. A juggernaut, Netflix it is. What are your expectations tomorrow, Alicia?
Yeah, I too believe that it's going to beat earnings expectations. The top line looks really like an easy beat. Some survey work that we did in the quarter, along with many other data points, indicated that there was a pickup in subscribers, and not just regular subscribers, people going to the premium tiers. And with the recent price increases, this just means more revenue per user, and Netflix should be positioned to beat on that with just so much leverage in the model remaining.
One thing that was interesting the last couple of quarters was the discussion about the ad business and how fast that's growing. What do you want to hear from them tomorrow?
Well, I do want to hear that it's growing, but more than the user base on the platform, the ads platform that's growing, is that their targeting and capabilities are strengthening, and that they're willing to continue broadening their partnerships. Speaking of Amazon, I think Amazon's ad platform and the recent partnership announcement with Roku bodes well for Netflix too. I think Netflix would benefit greatly from partnering with the likes of Amazon and just increasing the programmatic capabilities that it can offer advertisers. It has so many users that it could really leverage the data across Amazon's platform and Netflix's viewership data to provide a really compelling option for many advertisers and grow that even faster.
What's the sweet spot with regards to this ad strategy and more importantly, the overall pricing of these various tiers? I mean, they've raised the prices. We're now at $7.99. That's for the ad tier. And I am curious as to how much pricing power you think they have on that ad tier. How high can they go before people start to question what they're actually paying for?
Well, as long as they're driving ad viewership and the ads are targeted at pretty high CPMs, which the advertisers are willing to pay if it's good targeting, they don't need to really raise the price on that ad tier much more. I think there's a lot of flexibility there, a lot of elasticity still. Certainly on the premium tiers, you see many people sticking with a premium tier, going back to the premium tier whenever there's a lot of content that they want to watch in a quarter. But as they pull back maybe on the volume of content that they watch, or they just need to save a few bucks, they can easily go to the ad tier and exchange some ad viewing time for a lower price tier. But still, yeah, I think there's still plenty of room there, but I don't know if Netflix will need it.
All right, Alicia, really appreciate you taking time for us. Alicia Reese is Senior Vice President of Equity Research at Wedbush Securities. Netflix is scheduled to report tomorrow after the bell. Expectations are relatively high, but apparently, at least based on options pricing right now, the potential market reaction might be a bit more muted. As we set you up for what to watch over the next 24 hours, we have quite a few other earnings that could also potentially move the market. General Electric and Pepsi both scheduled to report earnings before the bell, and both have pretty interesting stories to tell. One, of course, on the tariff and trade front, and the other much more about industrial policies here in the United States. Meanwhile, we do get those Netflix results after the bell. We're going to have full special coverage in the 4 p.m. hour, hitting all of Netflix's business, including the build out of that ad business and its entry, believe it or not, into theme parks. We also get economic data tomorrow as well. 8:30 a.m. We're going to get a read on retail sales as well as the latest weekly jobless claims numbers. And we do get more Fed speak, this time from Kugler, Cook, and Waller. These are speeches that are scheduled to be pre-written, though at least 2 of those speeches will come with a Q&A. I'm sure they'll be peppered with questions about Jay Powell's future. We'll have full coverage of that right here on The Close. Please join us tomorrow. But for all your political coverage, stick around. The team at Balance of Power is coming up next, right here on Bloomberg.